All right, guys. Good solid rally for the market today. We're going to go talking about all of the charts from the S&P 500. I'm going to talk about the Russell 2000, the NASDAQ 100 composite as well. I'm going to go over the VIX, a lot of the indicators just to see how healthy of a market rally are. But I'm also going to spend some time on oil and crypto, and then I'm going to look at all of your charts as well. So whether you're watching on Facebook, YouTube, Twitter, show me what stocks that you want me to look at. Tell me what stocks you're trading, and I'll take a look at it, each and every one of them. So sometimes these things can go for, 40, 45 minutes, depending on how many people are asking about different stocks. So we'll knock all of them out, and make sure to hit the like and subscribe to this channel as well. That helps me continue to grow this YouTube channel, and that means a lot to me in the process. The breadth was really good today. All the industries were up at least 1%. The ones that were dragging was healthcare, defensive, telecom, and utilities. Now, outside of healthcare, what does all those have in common? Well, they're all defensive stocks, like staples. That's going to be more of your like stuff that you have to have regardless if you're in a recession or not, like beer, toilet paper, all of those like essentials like condiments, utilities. You got to keep the power on during a recession or Lord willing. So those are the stocks that tend to not do as well in a risk-on environment. Risk-off, people tend to flee more towards those kinds of stocks in those sectors. So the ones that was leading today was basic materials. You also had financials. You had industrials. Energy was really strong today, and we're going to get more into the oil stocks and crude as well. So where do we stand with this? Is this, really good rally today? You had the NASDAQ, it was up 1.6, which actually was the laggard of the big three. The S&P 500 up 1.9, and the Russell was up 2.5. So technology wasn't at the top of the pack, wasn't one of the top sectors either. So is this just something that we can say, hey, we're getting ready to break back out again? A lot of people are talking about how this is still a bullish market and that we have nothing to worry about, and all is fine in the world going forward. Well, I don't sign up to that. And now I say that, and like the market's up like 3.5% since Russia declared war on Ukraine. So you're thinking to yourself also, it's like, if Russia-Ukraine was so bad, why is the market actually up since then? And it's a good question. So let's go ahead and get into all of the charts here. Here's SPY. So the things that I'm watching for on SPY here, first and foremost, you have this massive neckline. And I've talked about before in numerous videos and other live streams how the head and shoulders pattern can be such a tease at times and very difficult to trade, in fact. Now, these head and shoulders patterns represent tops in markets or in stocks or whatever instrument they're showing up in. In this case, it's the S&P 500. It's also in the NASDAQ. Really well formed here. Left shoulder, you got the head, and then you got the right shoulder. You got the declining trend line here as well that shows that even though the market has put together a good rally over the last 5 trading sessions, it actually hasn't been able to, one, break this declining trend line here, and 2, put in a higher high. Now, if it puts in a higher high, it's going to have to get back above the February highs. If you're going to get above the February highs, that means you're going to nullify the head and shoulders pattern, which is possible. But it's a tall task. It's a tall order for the market to be able to do that. So in order for the market conditions to drastically improve, 1, it needs to break this declining trend line. And then 2, it needs to break above this right shoulder, which would nullify the head and shoulders pattern and put the market back on course for a move to the all-time highs. Right now, we are nowhere near that. So I'm a little bit hesitant to get long on the market. I didn't get long here, when it bottomed from the start of the Russian-Ukrainian war. That would have been pretty much like trying to catch a falling knife, and that's not really what I'm in the business of doing. I'm looking to go where there's a good edge. Now, we have consolidated out of the last 4 days, you could say. I know that Friday we were up significantly, but since then it's been consolidating within that body. Do we break out here? And if so, the next step is going to be the declining trend line, which gets closer and closer to price action every single day that we don't break through it. So what makes that so difficult is that the reward to risk ratio is not that great. So if you were to trade this market, let's say you were to get long on SPY, let's say you get in on a break of Friday's highs, like around 438. You put your stop loss, and I'm just going to try to use whole numbers here just to make it easier for you. Let's say I put my stop loss at 427. That's an $11 stop loss. Now, what do I need it to do in order to justify a 2-to-1 return for the amount that we're risking of $11 on this? Well, you would have to get $22 to the upside. $22 to the upside would mark it all the way up here at 460 or so, just above the right shoulder, actually. So it would have to break this declining trend line. But the problem is that it's tested this declining trend line on multiple occasions and has not broken through it. So that creates a lot of problems for me wanting to get long on SPY when it hasn't managed to break through this declining trend line, because my assumption is going to be, because we have a series of lower lows right here, and lower highs here, here, and maybe here. We just don't know that yet. I'm going to assume that it's going to struggle at 444. So you're talking about, okay, getting in at 438, and tomorrow testing this like it'd be about 444. So you're trying to get in with 4% of potential rewards, $4 of potential reward, and you're risking $11. So it's not worth it to me. It's amazing how every time I do one of these broadcasts, I get people who try to copy SharePlanner and try to act like they're me, and I have to block them every single time. I don't know what it is about wanting to mimic me, but if you guys see it in the comments sometimes, at least on Facebook and Instagram, they're constantly popping up. Just ignore them. I'll never ask you guys for any personal information. I can assure you of that. I'll never ask you guys to send me money or anything. So, all right. So SPY, we've kind of covered SPY, why I'm not long on it. So you look at Qs. Qs are kind of improving more so than SPY in terms of it's at a make or break point right now. It's at the place, okay, are you going to break out? Are you going to push through this declining trend line? It's at that moment here. Declining trend line, it's been rejected, on multiple occasions. And now it's right there again. Now what's also interesting, and there's a little bit of subjectivity to this neckline. And that is that can it bounce off of this neckline or not? Or where do you draw the neckline? So with the neckline, this is probably the most conservative way. And you can see where back in January and February, we broke below it, but now we're testing that underside of it. So is the resistance going to reject price and send it lower tomorrow? Because it pretty much has to, because you have the declining trend line weighing on it, and you have price level resistance, which is the neckline of the H head and shoulders pattern pressing on it as well. So can it push through it tomorrow? If it does, that's a pretty big deal, because two layers of resistance will have been broken. And I think then you can try to maybe play the Qs all the way back up to the top of this right shoulder. You also have a little bit of possible resistance at the 50, though if you look at it, it hasn't respected the 50-day moving average or the 200-day moving average all that well. Maybe more so the 200 than the 50-day. So that's what we have going on the Qs. Now, I was actually, believe it or not, I was actually long on QID today. And I'll explain a little bit of that to you here in just a second. But I got into it yesterday, and it didn't work out for me at all today. So I got into it, and like with 7 minutes to go, I was up like 1.5%. For those who don't know, QID is a 2-to-1 inverse of the NASDAQ 100. So I was expecting the NASDAQ to go down, and it was doing that for the most part yesterday, and I was up about 1.5% on the trade with 7 minutes left of the trading session. And by the end of the day, I was like down 0.3%, and then the market kept rallying today. So early on, I got out at, and I'll show you what was my justification for it here, so you can just kind of learn how I manage a losing trade. So you can see I got in. It's got this nice basing pattern. It's starting to break out. Then we had that ugly close within the last 7 minutes, and then we opened up lower today. We established lows early on. Then it bounced back up. Okay, it looks like maybe Ben Bernanke's comments were not going to work out favorably. No. So what happened was it came back down, tested this like 1987 level here, and then made another attempt lower, and then it just fell apart. Well, I'm looking at 11 out of 11 sectors trading higher. I'm looking at breadth being almost like over 2 to 1, almost 3 to 1 on the day. VIX, the volatility index was at the lows of the day. And I'm thinking to myself, I could just hold on until the stop loss is triggered, but what's the justification at this point? There's really not, because you got this big nasty candle, broke through the lows of the day. Qs are rallying. Market indices, Russell, S&P 500, they're rallying. So what would keep me in the trade at that point? So I just went ahead and sold it. I didn't want to trade it, or I didn't want to sell it. Okay, I really didn't want to. It annoyed me, but it was the difference between taking like a 4.5% loss and taking a 2.3% loss. So it might have been like a 4% loss versus a 2.3% loss. But that was a big difference, though, maker for me, because there'll be other winning trades throughout the year. But those winning trades are only reflective of how well I managed the losing trades. So I'm able to get more out of my future winning trades by the fact that I kept the stop loss so tight and actually got out before the stop loss, knowing that it was going to eventually hit it. And it did. It went, my stop loss is at like 1947. It went as low as 1942. So I would have been eventually stopped out, but I was able to get out at a much higher price because the charts were just telling me, Ryan, the only thing you're holding on to right now is your pride. And yeah, I don't like getting out of it and I hate it. And, you know, in the trading block, it feels a little bit embarrassing at times when you get stopped out, but it does happen. I'm going to get stopped out plenty of times. And I can guarantee you I'll have plenty of losing trades in the future, but it's those losing trades that will determine how profitable I am because of the manner in which I manage those losses and I don't let them get away from me. Okay, so we've got QID taken care of. Let's and Luke here, he was in there as well. Appreciate the kind words there, Luke. So all right, so I'm 100% cash now. So I'm not giving you anything that comes from a bias, you know, towards what I need the market to do here or what I want it to do. It's coming from what are the charts telling me here. Let's go back to the charts. And I think I didn't show you the actual price action on the QID, but just to sum it up real quick, broke down, broke back up. And then when it started breaking down right there, that's when I decided to go ahead and get out and went all the way down, hit my stop loss at 1947. So apologize for not transitioning to that chart there quick enough for you. IWM is probably the most bullish of all the charts right now in terms of indices. Going to the daily. So when we talked about this before, we're saying, hey, there was a bear flag setting up here. The bear flag confirmed, but it didn't really put in new lows, slightly lower lows, but not really substantial new lows. So you have what looks like a double bottom here. So let's get rid of this bear flag pattern because it's really not in play here anymore. So now double bottom, and now price is pushing up towards this 207.50 level. I'd say if you're trying to be super comfortable with knowing when this thing tries to break out, let's say above 207.27 is probably the breakout, but that's where it would confirm this double bottom. Then you also have this declining trend line here, getting close to testing that, not quite there yet. So even if it confirms, it needs to get above that. The cool thing about that is that it'll almost be in conjunction with this declining trend line. So keep an eye out on that as well. Volatility Index, VIX. Look at this, guys. This is one of the most interesting charts out there right now. And what I'm seeing for the most part, actually, by the way, I'm running around, I'm acting like a cat chasing a laser thing, but I filled me up some 4 rows of small batch today. So, but with the VIX index here, you have a strong layer of resistance going all the way across. And then you can see going all the way back to like June of last year, or no, 2020 actually. So this is, you're talking about 20 months or so of price action. Price cannot get above it on the VIX. It can't sustain a move above it. So right now we're sitting at 30, but look what we did. I mean, it's like every single time you get above this resistance level and it's the immediate selling that starts to kick in, pushing price back below this resistance level before the close. Again here, I mean, what is this? 4 out of the last 5 trading sessions, this resistance level has been an issue. So So VIX here, I'm looking at it from a daily chart, okay? And Maxim was saying that he's having a hard time seeing that. So trying to help you guys out with that. I will let you guys know I'm looking at VIX. Most of the time, I'm looking at all my charts on a daily chart unless I say differently. So just keep that in mind. If I don't say something, it's usually because I'm not looking at it, but except through a daily chart. So VIX daily chart. We're not breaking through it at all. I mean, going all the way back to June 2020, we can't push through this level. And it hits every time as like temporary bottoms. What is this? This is the June or January 24th bottom right here. This is the February 24th bottom right there. Every time it tests, it creates a new bottom for the market to catapult itself from. It's kind of frustrating because more than anything, I don't care about us going all the way back up to 86.90. That's not what I'm looking for, but I'd just really like to see a full capitulation moment for the market, and you're not seeing that. And a lot of times the reason why you don't see the capitulation in the market just yet is because there's not enough fear baked into the market. So yes, we've seen some pretty heavy selling, but it's been very orderly selling that has not scared a lot of bulls out of their long positions. They're still trained to keep buying the dip, and every time we get back down to what we saw in January or February, you see the bulls come back in and buy the dip because there's no fear. But that's what the market actually has to ultimately do, is they have to create the most amount of pain in order to get a significant sell-off. They have to lull as many people as possible and traders and investors into a false sense of security as possible. That's why, I mean, Kathy Woods, even, with ARK, and I see people on CNBC all the time calling this is a market bottom and everything. And maybe it is. Maybe I'm wrong about it. I still think that there's more downside to the market. I'm willing to trade to the long side, but the opportunities have to be there. And right now, I'm not really seeing a lot of great opportunities. But the market has to lull as many people into a false sense of security that everything's going to be okay going forward, because it's when you get all those people in there thinking that there's no way that the market goes any lower or that the market could get any worse, that it pulls the rug from underneath them and creates that panic selling scenario. Because right now, people have already taken a lot of losses. Some people are down 10, 15, 20% of the year. Not me, but I'm actually positive on the year, which is great, mainly through shorting IWM and shorting the Qs, and maybe a little bit of the S&P. But so all these people, they've already taken losses, and then the market pulls back and they're like, okay, all this cash that I have, I'm going to go ahead and put it into the markets. I think this is a bottom, and when the market bounces back, I'll be better off than I was before the market tanked. And then that false sense of security is what kills them. So then they pull it all the way back, and the market starts to pull back, start to sell, and then they start to capitulate. The bears, they start to get more aggressive to the downside. You start to get margin calls for the bulls, and that's where you get your capitulation moment. So I need a little drink after that. All right, so we're talking about the VIX. Still sitting below that resistance level until you get a significant break above this resistance level and holds into the close. It's hard to really say that we're anywhere near capitulation in this market. Okay, so we talked about that real quick on the indicators here, because they're pretty important too. This is a T2108, 40 stocks trading above their 40-day moving average. Still, you got about 38% of stocks trading above their moving average. You're not seeing capitulation like what you saw in 2020 or late 2018. This is where you got to get into the single digits. That's the other reason why I don't think this market has really seen capitulation. Instead, it's just gone back down to where it was, in January, again in December. I mean, not a true breakdown in stocks. T2107, this is the percentage of stocks trading above their 200-day moving average. A little bit more bearish, and it's also nothing more than a series of lower highs and lower lows, except for here. I'm starting to get a little bit of a double bottom there. So, all right. We got oil and crypto that I also want to look at here real quick. So I did a video on this last night. Check it out. It's on the YouTube channel. So I won't go all the way into it, but going back to 2015, 2014, massive inverse head and shoulders pattern. And what that looks like is this here. You got the left shoulder, the head, and you got a right shoulder, okay? That sucker confirmed in a blaze of glory this week here. I mean, strong volume, pushes through. I said on the video, I kid you not, I said on the video last night, all right, you know, we're approaching some heavy resistance from 2011 and 2013, that a good chance it might struggle with some. Nope, not at all. Instead, it blasted right through this resistance here today. So it's above it. I think there's still the possibility that maybe I was a little bit off on the resistance. Maybe it's more like at 115. I'm not sure yet, but there's only one other price point for that, and that's the highs from April of 2011. So you're talking about 11 years ago. But it clearly, price did not have any nostalgic feelings for this resistance level going back 11 years. So that's the week, or that's the daily chart. I'm going to look at the weekly chart on crude here. And this is the all-time highs. This is where we got, you know, in the 2008, once the recession started kicking in, you can see where we dropped from like 147 all the way down to 34. I mean, that was a pretty big move, right? But once we get past this choppiness here, and that's pretty much what that is. There's a lot of choppiness right in here. We get past that. What's to really stop us from going all the way up to 147? It's kind of interesting, though, that there will be a lot of people from a political standpoint trying to put the brakes on this. They'll be trying to get Saudi Arabia to put more, flood the market with more oil. They may be trying to, if it gets up to 147, you may see countries more willing to negotiate with Russia if there's a ceasefire, you know, and dropping some of these sanctions just to get their oil. So there's a lot that could be going on there. All right. And I'm about to get to y'all's questions here. I'm on one last one here, and that's going to be crypto. We're just going to look at Bitcoin. Going to the daily chart. Head and shoulders pattern here. Okay. We confirmed it. We broke lower, and then we didn't break very far, though. And that's kind of, like I said, it's the tease of a head and shoulders pattern so often over the past 12 years is that you'll break just a little bit below it and then go right back up. So now you got what looks like a double bottom pattern trying to form, and it hasn't closed above it yet, but it's holding its own just below it. So I wouldn't say that's a sharp rejection of price. Let's see if it can't consolidate for a few more days and then break right through. I have some theories. I mean, I think that a reason why the Bitcoin is holding up so well is there's a lot of people in the Eastern Asia, like with Russia, where their currency is just getting devalued. They're like, I got to put the stop to this bleeding. I'm putting it in a Bitcoin. Maybe Bitcoin will come back up and I can get back some of the money that I lost over the past weekend. So that's the look on Bitcoin. Now let's look at some of y'all's charts here. Can I look at net? Yes, sure can, Craig. Actually, let me put it on my other chart here. Okay. Net. We're talking about a double bottom and Bitcoin. Check out the double bottom here with net Cloudflare. Double bottom, hasn't broken above it. Tried to yesterday, but it really. And again, a lot of people say, Ryan, that's not a double bottom. Why is it not a double bottom? Well, because it doesn't go all the way down to 80. Instead, it goes down to 88. But a lot of times, technical analysis isn't required to be price perfect, in the sense that if it goes down to $80.01, the second bottom has to go down to $80.01, or it's not. There's a little bit of subjectivity in that sense, that you're trying to decipher, what is the chart trying to tell me here? Well, it's trying to put together a base in the form of what looks like a double bottom. So I'm comfortable calling it a double bottom. You got the breakout level here. I would probably say, because of this price rejection here and this price rejection here at the 200-day moving average, wait for it to get above the 200-day moving average before I would be considering a long position on it. But yeah, it's broken the downtrend. That looks pretty good too. Nice double bottom. I like the look of net. I think it looks pretty good, and no qualms there. And if it breaks out, I think, and it's a volatile stock, right? I'd start targeting maybe 137 to 144 as a potential price target. Luke says I need to give Navy rum a try for the next podcast. I do. There's a couple of rums that I do like, and so maybe they'll eventually make it to the podcast. Every year I do the podcast, I'm worried I'm not going to find 100 more whiskey because I do about 100 podcast episodes a year. I'm always worried that I'm not going to have enough. Thank you, Robert, for the kind words there. Hope you're having a good day as well. All right. Techo 86. Sorry if double post. It wasn't a double post, so you're good there. Bought 2024 Ford Leaps today, sitting right above key support and 200-day simple moving average on the daily, 30% off of all-time highs. What do you think of the chart? This was actually on my watch list today. I didn't buy it, but it was definitely on the watch list. It was one that I thought was setting up in a favorable, bullish manner. Reason why? Up 8% today, so that was a big move there. This is the daily chart of Ford. If you're looking at it from a 5-minute chart right here, you can see most of the gains were made within the first couple of hours. It did proceed higher throughout the end of the day and into the close, but majority of the gains were definitely made in that first couple of hours of trading. So you got a little bit of resistance here that you want to be mindful of. That resistance breaks, it should go into this gap. Let me zoom in a little bit further for you. This is your resistance. If it breaks above the resistance, should go into this gap here. I like the support at this 200-day moving average. Now, one of the challenges is going to be is where do you put a stop loss if you're looking to get long? The best thing that could happen here, and this is simply for helping to manage the risk better, is if it can get into this resistance here, not break it out, but get really close to it and then consolidate just a little bit. Okay, so just below the resistance here, if it can just consolidate just a little bit for like a couple of days, and that's going to be very difficult to do in this market. But after that consolidation, if it can break out, then you can get long and put the stop loss below recent resistance. You know, maybe you can even put it because the stop loss is going to be the hard part. So I think you can probably put it in, let's say if it breaks above like 1842 or so, you could possibly put the stop loss below 1730. It's not the best stop loss, but I mean, it's workable. If it can get into that 200-day moving average or into that gap from February, then you stand a chance to get that gap filled all the way up to like around 1990. And then, so yeah, it's 30% off of the highs, but I wouldn't look at it as like, oh, we're going right back to the all-time highs. There's a lot of headwinds for this market right now. And so depending on how aggressive the Fed ends up becoming, if the Ukraine-Russia conflict ends up subsiding and everybody just takes their ball and goes home, I don't know if that's going to happen or not, but if it did, it would probably give the Federal Reserve more ammunition to be more aggressive with the rate hikes. Good chart, though. Let's see. Can I take a look at any potential breakout targets for Wynn? It is consistently bounces from the low 80s. Yeah, this thing's always flashing up on my charts. So you got a good basing pattern. Yeah, it continuously holds that $80 level. I mean, it's broken a little bit below it back in December, going down to 75, but for the most part, pretty nice basing pattern. Let's see. You could make the case that it did break above this little declining trend line here, and now it's trying to break above it again. It's a little bit messy. I'm trying to think, where could you get into this stock at? I don't know if you're going to find a good, decent reward risk ratio. It's probably going to be like Ford. You're going to need it to get right up to the cusp of a breakout level. And right now, I'd probably say this is your breakout level. Gets above, and that 200-day moving average has got to drop below it too. It gets above like 97. If there's some consolidation here where you can maybe put the stop loss at like 92 or 93, that would be nice. It'd be really nice. But that's probably how I see it. Now, if it breaks out of that level, what's the next levels to look at? Okay, we're assuming a breakout of 97. 107 would probably be the first target there. And then playing it safe, 117, because you got some resistance here and right in there at 120. So somewhere between 117 and 120 would be the ultimate target to try to take on with Wynn. All right, CVX puts for a retrace here. That is not CVX. This is. Okay, so I actually have some of this in one of my long-term portfolios. Bought it a while back. I bought it for the freaking dividend. I didn't have any idea it would do something like this. Crazy stuff. But I think it was like paying like an 8% dividend, and now I'm like up 90% or something crazy like that on the stock now. But anyways, for in terms of a put, I don't want to sound biased when I'm saying this stuff, but I wanted to let you guys know that. But with CVX, you got this parabolic rise, and it used to be really popular, especially like penny stocks, is to find these penny stocks that had gone up like 300 or 400%, and then to like short the penny stock. And there was times where you could actually find shares of the penny stock. This is probably going back like 15, 20 years ago. You get the shares of the penny stock to short, and you can make some massive gains, like crazy amounts. Now, the problem with that is that sometimes it could go up crazy amounts still, even after it had been up 400%. And so while you could be right 9 out of 10 times, it was like that one trade that didn't go right that could wipe you out. I mean, just could destroy you as your portfolio. So CVX isn't a penny stock. We all know that. But it kind of goes back to the old saying, don't step in front of a freight train hoping that it's going to stop. This is a freight train right now. I don't know how high oil ends up going. I don't know how much this war in Russia is going to escalate. Maybe they have peace talks and everybody goes home, like I was saying earlier. If that happens, it's going to weigh on stocks like CVX and all the other energy stocks. Oil prices will come back down again as well. But until that happens, you don't have to get short right at the peak of a stock. It's better to usually let stocks start to break down first before you get short on. So like with CVX, I would probably back off. I'd say, hey, you know what? This thing's on a crazy bull run right now. I'm going to let it show me first that it's wanting to pull back some before I get short. Because will it have a pullback sometime in the future? Yeah, but where? I don't know. I mean, honestly, I wouldn't mind adding more to my position, around the 126 level, if it was to pull back down there. But it could go up all the way up to 164 before it ultimately pulls back. And maybe it only pulls back to like 137 or something. And, or maybe it only pulls back down to 154. Who knows? But it's better to wait to see if it's willing to start to break down. And right now it's showing zero willingness. Thanks, MB, for that question. All right. Kevin McCarthy asks, could you give me your thoughts on AA? I sure can. This is a daily chart, AA, strong volume over the last 2 days. Crazy. I mean, we were talking about metals being one of the strong sectors of late, right? I mean, up 2.6 led the entire market higher. So let's look at basic materials first. For the most part, it hasn't gone anywhere since May of last year. So materials is going nowhere fast. There's some good solid rallies, but for the most part, that's your material sector. Now, why do I not use XLB? Even though the charts are pretty much the same, it's not going to have as many stocks in it. It's got like 28 of them in there that it's measuring, whereas this one here has 322 stocks in it that it's indexing. So sideways going back to May, but let's look at AA. Clearly not the case for AA. Alcoa continues to rally higher. So where's the trend line at here? That's probably what I would call the best trend line to follow going forward. It's well off of that trend line. Now, they tend to come back down to these trend lines. If you just look at this thing over history, okay, it got pretty detached from that trend line right there. But then check this out. Comes right back down. And then it goes right back up, gets detached from that trend line, gets even parabolic here, right? But then it comes right back down. So we're in another phase here where it's just going straight parabolic. And if I'm looking to get long on it, I'm waiting for it to pull back down to this $51 level, which would be like a 37% pullback. Kind of crazy, but I do think that maybe it doesn't go straight down from here. I wouldn't expect it to, but maybe over the next few weeks, this trend line gets maybe up to like $55, $56, and it goes from like 82 down to 56. So nice chart, nice trend line. It's still bullish. I mean, nothing's saying sell it at this point. If I was in it, I'd probably be taking a little bit of profits off the table. But if I'm looking to get long on it, it's definitely not at 82. I'm wanting to get long on it closer to like the mid 50s. Going back to Techno's question about Ford, he was saying that he was looking at it from more of a true long-term hold. because it's leaps that expire in 2024. So yeah, I mean, I think when it comes to Ford, I think that, you know, the 200-day moving average was a good place to try to play it. My question, and you got time on your side, obviously. My question is, you know, how much further does this market decline if the bottom's not in just yet? If it's not in very far, I mean, you've seen just what it's done since January. You know, it's gone from 25 down to 18. It could go from 18 maybe down to, you know, 13, 14, or 15. Nobody knows that. But I mean, if you're looking to get long on something here, I mean, that 200-day moving average is a pretty good starting point. So I like it. We're going to look at SLB here. This one has not been following the energy stocks as well as, like, say, Hess, or like what we were just talking about, like CVX or XOM. SLB has struggled some. I think it's because they have some exposure to Russia, but it's kind of gone messy here. I'm trying to see my other charts. You had this bull flag here forming, and it broke out, and it was like, okay, nice bull flag breakout, and then it just fell apart. It just head faked and fell apart. So I haven't been as willing to want to get in on this one just because that head fake kind of threw me off. You could even say that there's no point of having that upper level there with that head fake, but we could say that maybe, you know, there's a little bit more of a bearish tone to this stock here. So I think if it breaks below this 37.50 level, that's not a time for me to want to be into the stock. I think it sets up the potential for a far bigger sell-off in it. The fact that it's not keeping up with just the energy sector, right? I mean, that's what it should be looking like right now, and it's not. There is some other ones worth looking at. ET. This has a inverse head and shoulders pattern in play there. It's starting to break above it. AR was another one. It broke out. How I added this one in the YouTube membership. Broke out of that. Really nice. Going from like 22 to 24. So there's some other good plays there. I think for AR, I'd wait for like a pullback and see if it wants to bounce off of this 22 level. So, all right, guys, that was a good session with you guys. Make sure again to like the video, subscribe to the channel. That means a lot to me as well if you're watching it on YouTube. And leave me some comments if you have any other questions. I try to look at every comment that everybody posts on this channel. So thank you guys. Cheers. God bless.